Hey everyone, welcome to the Balance Lens, where we examine faith, culture, and politics from a balanced perspective. I say balanced because we try to lay aside our opinions, look at the hard facts, offer pragmatic analysis, and then apply a biblical Christian worldview. Today, we're talking about something that everyone cares about. We all care about money. And so today, we're talking about the US economy and exactly how it's doing. Now, depending on who you ask, people have different opinions on the economy. You ask someone who's maybe Republican or leans right, they say the economy is amazing. Things are going well. They're optimistic and they're hopeful. Yes, someone that leans, maybe someone that votes Democratic or leans on the left. And to them, it's doomsday. The economy is just tanking. And so we want to wrap our heads around what exactly is happening in the economy. And so to start off, how do we actually assess the current state of an economy? Is it by how we feel or how much money we think we have in our pockets? Like, how exactly do we go about examining a topic as complex as the economy?
And that's a healthy question because it's not as straightforward as people think. Economists disagree with each other, but in general, they use a combination of various types of data. They would call it hard data versus soft data, and they both actually matter. So, hard data are metrics like the GDP, the industrial production, employment rate, the retail sales, inflation, interest rates, and they are actually measured by government agencies like the BLS, the BEA, the Fed, etc. Then there are soft data. Soft data like surveys done of the consumers and businesses to understand the sentiments, the market expectations, opinions about current and future conditions, right? Like there is a University of Michigan Consumer Sentiment Index, or there's business confidence indices that people look at. So that's soft data. So what happens is you have the hard data that provides the factual baseline of what is happening, but remember, they tend to be lagging. So it's already happened. And soft data tend to be more timely and forward looking. But there's a caveat that they can be heavily influenced by politics, media, emotions in the moment. Like I'll give an example, right? If you look at some recent years, the consumer sentiment often seems like very pessimistic. But when you compare it to the actual job growth and GDP and retail sales, it's actually pretty solid. The hard data shows you solid footing of the economy, whereas the sentiments give a different view of it. It gives an example of how you have to balance these things out and ensure that they align and that you kind of account for the situation at hand and how people feel. So there's, like I said, when you think about a sensible assessment that is done by economists, they look at activities like real GDP growth, the production employment levels. They also look at price and money aspects, which includes inflation rates, what are the expectations, what is the money and credit growth, and how are the policy interest rates. And they look at households to understand what's the real wage growth, how's the consumer spending look like, how's the debt service burdens look like, plus the consumer sentiment that you're referring to. And they also look at public finances and external balances like budget deficits, debt to GDP ratios, trade and current account balances and deficits. And so it's a combination of these factors, which I'm sure as you're listening, you understand that it's actually a complex set of variables. And depending on which economist gives weight to one versus the other, you will hear different opinions on the matter.
Yeah, excellent analysis. And if you ask like cousin Billy and then you ask like Aunt Joanne how the economy is, right? Everyone's gonna have a different opinion. So you got to start somewhere with like actual numbers, actual metrics. This is a little nerdy, right? A little geeky, but you've got to look at these numbers to determine like where exactly we are in the country. And so we'll try to give you an unbalanced, unbiased perspective. Again, everyone has their own opinion, but we're just going to share some hardcore numbers here. So the first metric we want to start with is something called GDP or gross domestic product. What exactly is that, and how has that changed over the administrations?
GDP is a very popular measure of how an economy is doing. It's essentially the addition of all the value of products and services generated by an economy, right? It's a total value. Now, just so that there is clarity, there is something called the nominal GDP and the real GDP, in the sense like the nominal version of it, like you have to take into account as you're looking at GDP growth, for example, that sometimes it may seem that the total value has gone up only because the price has gone up, and the price has gone up because inflation has gone up. So you have to kind of account for that inflation and see what is the real GDP growth, right? So GDP, again, like I said, is a summation of the entire value of goods and services that is generated by a country. Like a few examples, just a few quick points, right? The US, for example, its GDP is about like $31 trillion, and it's a quarter of the global GDP, 25% of the entire world. Even though we have like 4, 5, less than 5% of the world population, and it just basically shows like we have a very high output per worker, right? It's a highly productive society, and even the GDP per capita, I believe, is about $85,000, which is really high and very. It just shows a very highly productive workforce that we have. So GDP is important. One of the things that so when you think about through the years, and again, it's really fascinating to see GDP growth over the various decades. All the way, if you go back to 1900, we were talking about 3.9% growth. Now remember, it's off a lower baseline, obviously, right? So it's easy to grow when your baseline is small, and as your baseline, meaning your volume goes up, every percent is a big absolute value growth. Just keep that in mind as you think through these numbers. But essentially, it was about 3.9%. It starts in 1900s. It dips down all the way down to 1%, the real GDP growth, in the 1930s during the Great Depression, and then spikes back up in the 1940s because there was a world war and all the war machinery was in place. So GDP at that time was 5.6, just so the listeners know. Then it goes back to a normal range of 3.1 to 3.2 between 1970 and 2000. Now, around 2000s, you have now in 2008, the big financial crisis, right? So the 2000s that decade had a lower rate of 1.9%. Now that it went up in the 2010s to 2.4%. And right now, in the 2020s, we are still staying steady at about 2.4% real GDP growth, which is pretty solid. We're talking real GDP growth, just to make sure that I'm clear, which means it takes into account the fact that there was some inflation happening, right? It discounts for inflation. So it's actually the real GDP growth. On average, again, you see that earlier on in the century, we have about 3-ish% growth during healthy times. The average would be around there. And we are right now in the 2.2 to 2.5 range, which is also pretty healthy. And we have held steady in terms of like our growth. As a reminder, I always think about we've been waiting for a recession for the last like 4, 5, 6 years now, thinking that a regular cycle is supposed to come, and it hasn't. Like our economy has been pretty vibrant. So yeah, that's a quick measurement of our GDP.
Yeah, that's excellent. I remember I had an economics class one time, and you had to sit and actually calculate this. There's actually four components. One is consumption, government spending, and investment, like net exports. All these things play into GDP. Now, if you're at home, you're thinking, how does this affect me? Like, I never see a GDP in my wallet, right? Well, it's kind of like the foundation to your house. Like, you never see the foundation to your house. Rarely do you see that, but it's what your country is built on. And so it's one of the most important metrics that we need to look at and analyze. As Biju said, if you talk to someone on the right, they'll tell you like the country's booming, like GDP's at 10%. It's not, right? We're at a modest, very normalized pace. To give you some numbers, right after COVID 2021, GDP 6.3%, 6.7, 7%. Again, this was after a year that everyone stayed at home where there was really no spending. So those numbers are expected to be high. 2022, negative 1.6, negative 0.6, 3.2, 2.6. 2023, between 2 and about 3%. There was one quarter with 4.9. 2024, between 1.4 and about 2.5%. So again, we're within that like 3 to 4% modest growth of GDP. There is speculation that the last quarter of 2025 may have broke a ceiling that our GDP growth may be up to about 4.2%. But nevertheless, the year on average was moderate. It wasn't booming. It didn't explode as many expected, but that's where we are. Now, that sets the foundation kind of for our metrics here. But one thing that affects people everywhere, you, me, is the unemployment rate. how we work, the percentage of people that are actually participating in the labor force. And so this is interesting because there's a lot of different aspects to the unemployment rate and how that's changed between Biden's term and then Trump's first year. So how has the unemployment rate been over the last few years?
Recently, I think the rates from the most recent period is about 4.4-ish, which is very healthy overall, just to give people an idea. And I always like going back in history. So if you go all the way back to the 1900s, we had a 4.5 unemployment rate. That is 4.5%. It kept climbing up a little bit in the 1910s, as obviously in the Great Depression. In 30s, it went all the way up to 18%, actually, the unemployment rate. Then it goes back down to normal levels, four-ish levels in the fours. A slight spike again in 1970s and 80s. If you remember, there was a lot of the oil-related issues going on in the world. Around that time, there was a higher unemployment rate happening. Around the 1980s, we were at 7.3. Then we went back in the 1990s back down to 5.8. Then 2000s it was 5.5. 2010s it got to 6.3, went up again, and then 2020s it's gone back down below 5, so to 4.8%, and right now we're about 4.3. So very healthy unemployment rate actually overall from an economic perspective, and so that's where we are.
Yeah, and just to throw in some fire here, right? Some people think that the unemployment rate like drastically went down under Trump. It actually went up a little bit. So 2024 under President Biden, the unemployment rate was 4%. As of Q4 2025, it was about 4.4%. So it did slow a bit. Probably a lot due to the government shutdown and a lot of layoffs in that sector there. But there's so many different aspects regarding unemployment. For example, there's something called wage growth. It's a very nuanced aspect of unemployment or employment. But wages did rise. Real purchasing power gains were modest. In other words, you might look at your paycheck and think, wow, 2025, I've got a raise. That was awesome. But in reality, the cost of things rose a little bit. And so the real wage growth, as they call it, was actually very modest. And so it's important to think through that when we ask ourselves, like, how much more do we make in a year? Wage growth measures that. Again, that was tepid. What's interesting, though, the employment rate for just the last quarter, just the last month, excuse me, January 2026 just came out, showed average hourly earnings year over year were up 3.7%. Um, there might be a bright spot in 2026. We'll see. But in general, 2025 was very moderate. To add some detail to that, there's another metric called the labor force participation rate, which is whether people are actually working or trying to find work. In other words, if you're not trying to find work, believe it or not, you're not counted in the unemployment rate. It's actually a nuance with the unemployment rate. Now, the labor force participation rate actually ended around 62.4%, roughly where it had been at the start of 2025. There wasn't like a drastic increase there. Another thing to note is that within different sectors, healthcare and social assistance continued adding jobs throughout the year. A lot of retail jobs were lost in 2025. A lot of federal government jobs were lost. There was an active push by the Trump administration to reduce the size of the federal government. The real unemployment rate, and this is interesting, many people may not know this is counting people who desire work but are unemployed but maybe stop looking. This is a metric that a lot of people track. It's called the real unemployment rate. December 2021, it was 7.3%. December 2024, it was 7.6%. December 2025, it was 8.4%. So that actually went up um, in 2025. You need to look at those numbers and ask, what happened in 2025? And we're going to jump into that a little bit. Now, again, on a bright note, jobs numbers for January 2026 just came out actually today. Job growth surged in January with 130,000 new non-farm jobs and 172,000 private sector jobs. That was exceeding expectations. The unemployment rate fell slightly to 4.3%. So what does this all mean? It means that, we didn't have this utopian dream in 2025, right? We had moderate unemployment growth. We had actually a real unemployment rate that increased slightly, due to a variety of different factors. But it'll be interesting to see what happens in 2026. And so, important to keep these facts in mind as you think about who's working and what types of jobs that they are working in. Now, the one thing that everyone knows about, you can ask your grandmother about this or anyone, and they know that prices have gone up a lot in the last few years has gone up. Like you go out to eat and it's like, man, how did that burger become like $10? Like, you could go out to eat at one point with your family if you were a middle class family, actually enjoy like a full meal. And now it's like, you buy a burger with some fries and it ends up being like $15, right? Just for one person. But looking at inflation, comparing that to the Biden administration, excuse me, and then under Trump, has that changed? Has it gotten better? What does that actually look like there?
So we had a big hiccup in inflation due to COVID. It really set us like off track a lot. I don't remember the exact numbers, but I think we were between 15 and 20% at some point, just briefly. But what happens is like, since then, obviously inflation's come down, right? The target inflation for the Fed is they'd like to see it around 2% inflation. So they measure it by the CPI, the Consumer Price Index. But just so people have also historic perspective, I just want to again go back. One of the decades with the highest inflation was actually the decade of the Great Depression, right before the Great Depression. So we had like 7.1 inflation around in that decade. Then it goes down and becomes stagflation at some point. It messes up entirely the economy because we start contracting. But historically, even like if I stick to the 1970s, where we had all that turmoil with the oil and the oil disruptions in the world, we were at 6.7% in that decade, 6.7%. Okay, then it goes down to 4.8% in the 1980s. Then it goes down to the moderate 2.3% between 1990 and 2010. Then in the 2010s, we had actually a period of time when the inflation was actually 1.7%, which is really good. But then you get to COVID. Inflation was on the right track, right until COVID. And then that obviously threw everything out because there were a lot of Fed policies also that contributed to it, like the quantitative easing. They basically pushed money into the system and the prices went up. We had supply chain disruptions all over the place, which means that your demand goes up, supply is constrained, price goes up, right? So for all those reasons, the price went up. So if you look at that big bump, but then it kind of started stabilizing. And if you take the average of 2000 until now, 2020 until now, the average is 3.9, which historically is still not terrible if you listen to all the numbers I said. But right now, we're talking about like the latest inflation, we are looking at about 2.7, 2.8% inflation, which is not at the target, which is why you will hear the Fed really reluctant to lower interest rates, even though the Trump administration is pushing hard. That is one of their jobs, to ensure that inflation doesn't go out of control. And they're trying their best to make sure that there is balance, right? If you lower the rates too fast, the economy can get overheated. When people start having a lot of economic activity and the prices can shoot up. As you all remember, it kind of started happening when there is a market constraint on goods and houses and we have too many buyers. Anybody who's bought a house in the last 5 to 10 years will see that you have had to pay much higher than the asking price in order to get the house. This is the balance that people do. But inflation right now is under control. So if you layer in the economy, the unemployment rate, the inflation rate, so far, all of these different factors are staying within the boundaries that economists like to see. But there are things that we need to pay special attention to make sure that they don't go out of control.
Yeah, and to put that in perspective with some numbers, under President Biden, inflation spiked to a multi-decade high in 2021, about 7%. 2022 was about 6.5%. Came down a lot in 2024 to 2.9%. And under President Trump, relatively stable, around 2.7%. Now, the average person doesn't feel this because the prices just have risen so much in the last 4 or 5 years. It's kind of like, if you get punched in the face like on Sunday, you're still going to feel it like on Friday. So, prices are still rising. It's expected to rise, but for a lot of people, I don't think they've translated that into actual savings, the fact that things are rising at a less faster rate. And so inflation is still there, but it's not 7 or 6% like it was under Biden. There's another metric here called core inflation that includes volatile food and energy. That also fell towards the low to mid 2 points, mid low to mid 2% range by the end of 2025. Another sign that underlying price pressures had eased over this period. Now, one bright spot I want to point out, though, is actually the cost of housing and the cost of renting. They were key inflation contributors until 2024. In 2025, both of those prices, the cost of rent and the cost of housing, actually increased at a much lower rate and at a much moderate rate than they had in the previous years. Now, some people credit this to the immigration policy, the deportations, self deportations. And so you have a lot less demand for rental units or even housing. But nevertheless, that has been good for the American consumer. I think a lot of people are able to, again, look again at a market and say, hey, I might be able to rent here because there's more vacancy and less demand. And so another perspective there just to look at inflation. But I think for a lot of people, we're still feeling it, right? That burger that was once $5 and went to like $9 is still like $9 now, right? It didn't go back down to five, which I think we all wish prices went back to where they were before COVID. So I know I'm definitely feeling it. And I'm sure a lot of our listeners definitely are.
Yeah.
But along,
Yeah.
yeah,
No, it's a great point that you make, right? Like we always want the prices like there are few commodities or few things for which the price fluctuates with the market. A good example is like gas. We can see the price of gas going up and we actually can see it going down. Not so with a lot of the other items that we go and purchase. So that's why even though the inflation is under control, right? We just feel like our pockets are being squeezed because if you look at the cumulative impact of inflation from 2020, and that's why I gave you it's the 3.9% inflation is almost double what the Fed would want to see. I just want to make one quick correction. I think I said like at the peak during the pandemic, we got to the upper teens in terms of inflation. I was wrong. It's about 9% was the highest at the peak mid 2022. So just wanted to make that quick correction.
yeah, thanks for clarifying that. And you're absolutely correct. All of us are still feeling the fire from those high prices. But along with inflation, another interesting thing that affects our economy is interest rates. When people refer to US interest rates in this context, they usually talking about the Federal Reserve's federal funds target range. That affects mortgage rates indirectly, definitely auto and student loans, business borrowing costs, savings income. The Fed has the ability to adjust these rates. This has been on the news. It's been very contentious if you've been following the news regarding how the Federal Reserve manages their monetary policy, and a lot of talk between the Trump administration and the Federal Reserve that's been quite volatile. But how have interest rates changed in the last few years, and how has that affected us?
I know you asked me for the last few years, and I'm sure you'll dive into that, but let me take you all the way back.
Yeah,
Just so
great.
that we
Yeah.
have historical context. Interest rates, like in the early part of so a century ago, right, 1900s, we're talking about a 4%, 5% interest rate between 1900s to 1920s. And then there's a drop for the next 2 decades between 1930 and 1950 because again of the war and all that stuff that happened. Then you have the 1950s onwards. The 50s was 2.5%, 1960s was 4.5% inflation rate. 70s, the turmoil decade, was 7.5% interest rate. Okay, was more than 10% interest rate. So whoever's been that old can remember the 10% plus interest rate. It went down. It came down to 5.5% interest rate in the 1990s. Came down further to 3.53% interest rate in the 2000s. Went down to 1% interest rate in the 2010s. Right? And then the 2020s, the average has been about 4.5, which is what we are feeling today. We're hovering in the 4.5, 4.75 range. So people who have a memory of recent decades because they tend to be more younger remember how low the interest rates were, and when you talk to them, that is what sticks out to them and frustrates them in terms of their inability to afford buying a home, which is one of the biggest price items in the American dream. However, if you talk to people who lived in their prime in the 1970s and 80s, they will tell you that this was an abnormally low period. It was an abnormal period of time when the rates were like close to zero. That's just unheard of in the historical context. I just want to make sure that everybody had that idea in mind. It's not ideal. That's why you have the Trump administration, specifically Donald Trump, really frustrated with the Fed that they will not unleash in his mind the economy by lowering the interest rates. But there is a lot more to it than the Federal Reserve thinks through before making their decisions. It is totally okay for the executive branch to express frustration. That is okay. But that doesn't mean that the Federal Reserve should act, because they have a very specific motto in mind and a goal in mind for them to get.
Yeah, and the challenge here is a balancing act. When inflation is high, the government tends to want to keep these interest rates higher so that people can get a higher return on their money. And so, the question for policymakers is, has inflation dropped enough where you can start dropping rates? But here's what happened. Ended 2024, rates were around 4.25 to 4.5%. Under the Trump administration, these rates started dropping. September 2025, one cut to 4.1%. October 2025, 3.75 to 4. December 3.5 to 3.75, the lowest in nearly 3 years. And so definitely more accommodative monetary stance as concerns grow over, slowing job growth, other economic headwinds, like many people wondering, is inflation really under control? But what's interesting here is that for a lot of people, buying a house is just completely out of the picture. Like someone that came out of college in 2019 that wanted to buy a house could reasonably buy like a twin house or even a single family house, if you had a decent job. Coming out after COVID, 2024, it's like the house of pricing has literally gone up by 50 to 75%, sometimes doubled in many markets. Insane when you think about how fast it's happened in 4 years. And so, an interesting thing that we'll see if this really has an effect on the economy in January 2026, President Trump announced that he was directing his government to buy $200 billion worth of mortgage-backed securities with the goal of lowering mortgage rates and making homeownership more affordable. Economists are cautioning about this. They're saying the benefits might be short-lived or even counterproductive, because lowering borrowing costs can boost demand for homes and then skyrocket prices again. And so we'll see, right? But I think for a lot of people, they know how much the student loans cost. They know how much auto loan rates have been. They definitely know how much mortgage rates have been. And so again, 2025, you look at this and rates have been moderate. Inflation has still experienced the after effects of the post-COVID era. So for many people, they're not really feeling a tremendous amount of relief here, though the government is, at a stable, moderate pace growing. But another more direct metric that can really help us understand how people are feeling is something you and I know, is how much we spend, right? Like, how much do you not want to spend? How much do you want to save? And so there's a metric called consumer spending, often measured as personal consumption expenditures. This accounts for 68 to 69% of GDP. I know I've been more cautious looking at what we buy at the grocery store. We've been more cautious looking at how much we spend eating out, because things have definitely been more expensive the last few years. And, I think a lot of people are feeling that same effect. But what are some interesting things about consumer spending that you can talk about over the last few decades or in the recent few years?
I mean, I'll give a personal anecdote, right? Too, and it's just been interesting and striking to me that the American consumer is very versatile and resilient, actually. Like last weekend, it was terribly cold. The low in the night with the wind chill was -22. And so my daughter wanted to go out and have dinner. We did. It was just crazy cold. But the restaurant was packed. We had to wait for an hour to get a table, and it was 4 o'clock. So it was neither lunch or dinner times. And so I was like shocked. And and this is what my experience has been throughout my time here in the US, whether up north or down south. People, if they are able to, will spend. Now, they may decide to spend it in different ways, right? So if you can't go to an upscale place, you'll go to a moderate price place. And if you can't afford that, you probably go to a lower price place. But they are still willing to spend. And like you said, We have about, what, 65 to 70% of our economy and the GDP being driven by consumer spending. This is why consumer confidence is important, and consumer spending and their habits, people always keep track of that. And it's been pretty vibrant. Um, Even so, earlier in the 20th century, it was a smaller share of our economy. We had a more higher manufacturing base, which went even more at the, if you think about the world wars, at that time, we had much more manufacturing happening here. But slowly as time went on, especially past 2000, right after China was admitted into the WTO, slowly and surely we have manufacturing shifting out of the country, which means that now we are primarily a consumer driven economy, with the manufacturing playing a smaller percent, not insignificant, but a smaller percent of the overall GDP. Right now, I would say the economy shifted to services, mass consumption, and even credit finance spending. A lot of people have credit cards, and you can see a lot of reports that say that the credit card bills are going up. The average amount of people, amount of money that is on credit cards are going up. So that's a quick summary of the consumer spending.
Yeah, that's an excellent point. People spend and put it on their credit cards, right? And, you justify it because it's on your credit card and you'll pay it off one day. But looking at the stats, 2021, after COVID, consumer spending rose 13.3% in 2020. That's a huge jump, mostly because no one was spending money in 2020. We were all trying to survive and figure out what in the world was going on in the world that year. 2022, spending grew by 9.8%. Again, 2021 was still considered, the midst of COVID. 2023, spending increased by 6.4%. 2024, the last year of Biden's term, consumer spending was 4%. Now, believe it or not, under Trump, it was just about the same. It was about 3.5 to 4%. I think the numbers are still being deciphered and yet to be published. But consumer spending was moderate, right? It didn't explode as many thought they would. I think a lot of people were still a little scared with the economy and the impact of tariffs, which we'll talk about in a second. But the pace of spending growth definitely eased in 2025. Real inflation adjusted consumption showed definite signs of flattening in parts of the year, and spending gains were really driven by higher income households, while middle and lower class income consumers definitely exhibited caution. So, if you listen to the media and especially the right, and they'll say, well, everything's rosy and it's blue sky and people are out there spending money. They are, but as Biju's been trying to do and I've been trying to do, you put this in context and you scratch your head, you're like, well, it hasn't been that rosy. It hasn't been terrible, but it's been moderate, right? It's been stable, but not booming, fragile, but steady. And so these numbers are very telling about the state of our economy. Now, one thing Trump promised has been to bring back manufacturing jobs to the US. And so another metric we want to look at is industrial production, not specifically manufacturing, but, encompasses that as well. Has that happened in the first year? Have we really seen this growth in manufacturing, and what's happened with industrial production over the last few years or the last few decades?
So I'll make a general comment on this, and I'm sure you'll dive into specifics. One of the, and I'm going to go jump into the inflations, the of these of industrial production or the lack thereof. As you can imagine, if you go back in time, right? So we had an agrarian society, right? At the beginning of our democracy in the early 1800s, we switched to more industrial type of production, and there's a lot of wealth being induced, and the US rise up to be an economic juggernaut, right, as time goes on. A lot of it is fueled by manufacturing early on. I'm talking about the 1900s into the 1940s, right? Especially you had the World War I, then World War II happening, and you had much more industrial production happening here. It slows down in the 1970s and 80s as people switch to more white-collar types jobs, and so we become more service-oriented and consumption. But it starts falling down dramatically again, like I said, post-2000. And we're at a point where the industrial production is at a historic low, right? And this is important for us as a society and as a country to think through, because there are people who don't agree with the way President Trump is doing things, and I understand why, but it is one of the things that he has been focusing on correctly is that we do need to have a sound manufacturing base and industrial production in the US. This is important, if not for anything else, but for national defense. The reason why we were able to churn out what we did during World War was because we had the manufacturing facilities that we could convert and then utilize them to make wartime machinery. If those companies like the automobile industry, if those plants we did not have those, the story would be totally different. So this is something that is really important for us to have. It is important to always have a vibrant economy that is well balanced with manufacturing and services. You do not want a lopsided economy because it's just like us maintaining our portfolio of finances. You want to have a well balanced portfolio of finances so that you're mitigating the risks that can happen. So that's my comment. And I know President Trump has been trying hard. Some of the investments and promises that we have gotten from the different companies, whether it is in the car manufacturing sector or the pharma sector. A lot of the pharma sectors have stepped up in order to avoid tariffs and pledged that they are opening up new plants. And they are starting to do it. The problem is, because we're talking manufacturing, it is not a flip switch and you get what you get, right? This is going to happen over the course of a decade or so. And we should be able to see the numbers climbing as time goes on in terms of industrial production.
Yeah, what's fascinating is that, I take the train into work every day, and as I'm taking the train in, you see huge abandoned buildings as I go through the city. These buildings were all centers of manufacturing where people from middle class working neighborhoods they worked in and they earned a good living and they came home and they were able to take care of their families working at these production sites or factories. Now they're abandoned, right? A lot of these jobs have gone overseas. And so, as you mentioned, right, there is an important implication for national defense, why we need to bring those jobs back. There's also an important implication for people that can't go to college or don't want to go to college and they just want to work with their hands. And that's a good thing, right? To allow people to have the opportunity to work at these types of factories. But zooming in, right? If you zoom in on industrial production and you ask yourself, what have US factories and mines and utilities, what are they actually producing? And you compare them to the Biden years, to 2025, the first year of President Trump's second term. From 2021 through 2024, industrial output started with a strong post-COVID rebound, then really lost a lot of momentum. And by 2023, 2024 is basically flat to slightly negative. In 2025, and this is to the Trump administration's credit, that changed. Total U.S. industrial production did rise about 2% year over year. That doesn't sound explosive, but it's a clear shift from stagnation, a clear shift from negative contraction to modest growth. Under the surface, the economy was really split into winners and losers. On the winner side, high-tech manufacturing surged. If you heard about AI and chip development, the computer peripheral equipment production jumped roughly 16%. I mean, that's huge. Semiconductors used in chips were about 15%. That lines up with, heavy investment in data centers and AI infrastructure. And so there's a lot of boom in that industry, right? If you're thinking about getting into manufacturing, this is a place to really be looking into. Utilities also grew around 2%, helped by rising electricity demand and weather-related load. On the losing side, car makers struggled, autos struggled, motor vehicles and parts production fell nearly 3% year over year, even though there were strong months. Part of that reflects tariff uncertainty. The Trump administration had a huge push towards more tariffs, which we're about to talk about, that caused companies to really front load and then pull back, creating this production whiplash. In shifting EV incentives in 2025, auto sector really faced a lot of volatility, especially after a lot of automakers had decided that they're going to go all in on EVs. And so, what's the big takeaway? 2025 was really a big move from industrial stagnation to selective growth. The US is definitely producing more, but the growth is really concentrated in, technology heavy and energy related sectors and not like all types of manufacturing. Like you're not going to see a new shoe factory or a clothing factory in your neighborhood tomorrow, but you might see a company that starts building things for AI infrastructure. So in other words, the industrial economy didn't roar back, but it did find a pulse and a heartbeat where it's beating the strongest, tells you a lot about where investment and policy is really pointing to. Another quick story just came out this week. There have been reports that steel production, again, is booming in the country. we'll see how that fares out over 2026, but something to keep your eye on, how exactly we do with steel production over the next few months and how uh, that reflects across our economy. Now, one thing that shocked me was actually consumer confidence. Consumer confidence is this metric that really just measures what the title says, how people are feeling. And so this is a really interesting trend that I thought, but in your perspective, how has consumer confidence been? What does it measure? And what did you find in your research here?
Like consumer confidence, we briefly touched on this, right? It kind of is cyclical and it's heavily influenced by things that are happening and what people are sensing and feeling, right? If we constantly think that there is a recession on the corner, or we are led to believe, like if you take I guess the most recent example was, what did he call it? Liberation Day last year. The tariffs were implemented. Almost every economist, I would say maybe 80-90%, said it's going to be dramatically have a negative impact on the US. That things are going to go bad, our costs are going to skyrocket, the trade deficit is not going to be solved, we are going to have a lot of retaliation, our markets collapsed, right? And now economists looking back and being like, were we completely wrong? Or is this just a incredibly delayed response of the market or what's going to happen? So what happens when you keep hearing that's what the experts say and that's what all the media says? Your own confidence goes down. I mean, I can say that my confidence went down too. So it's not like I was not part of the mix. So that's the problem with consumer confidence. They're normally thinking about it based on what they feel and how things are going for them. Now, a lot of the times that's not unimportant, right? How they feel matters, because if we are driven by consumer spending, then it's important to understand how the consumer thinks about spending. But it's a metric that economists use to keep an eye out on how people are feeling as a leading indicator. But they do take it with a grain of salt ultimately, and ensure that they calibrate. That if there are several recent examples where the consumer confidence levels were the lowest recorded, but the economic growth, the labor market, everything stayed steady without any problem at all. So it was a feeling that people got and received from based on their stimuli, but it did not actually pan out in reality.
Yeah, excellent point. And consumer confidence is a really interesting metric that's tracked. It's tracked in something called the University of Michigan Consumer Sentiment Index. It's been around for a long time. Over 100 generally indicates good. Things are going well. People are optimistic. They're looking forward to the future. Under 100, specifically under 75, people are generally very pessimistic. And so December 2021, this is right after COVID or in the midst of COVID 6. The year after, December 2022, the number dropped to 59.8. December 2023, there was a rebound and people were actually coming out more, starting to spend more money, 69.7. December 2024, the number increased even more to 74. Now, here's the shocker, and I didn't know this. 2025 consumer confidence index actually dipped by December 2025 all the way down to 52, down significantly a year from before at 74. Now, again, as Biju mentioned, 10 people tell you that your hair is red and your hair is not red, you're going to start believing your hair is red. But this is how people feel. I mean, you can't negate what the numbers say. People could have been scared about tariffs and just how the economy was going. And so people are not expressing a lot of confidence in the economy as of the end of 2025. And so that's something to keep in mind and something that's important to understand as you talk to people, that they may not see the world with this beautiful, rosy view that you see it with. And people generally are very pessimistic about the economy. Another thing that was really interesting and actually kind of scary to research is the amount of debt in our country. And this has been the talk of a lot of news, and a lot of people have expressed concern about our growing debt. To put it this way, if your household was in a lot of debt and it just kept getting bigger and bigger year after year, decade after decade, you'd have a family meeting, you decide you want to scale things back, maybe cut out eating out, cut out going to the movies, postpone buying the new car. America has done the opposite. And so when we look at debt level in this country, what's happened and how does that impact the economy here?
A lot of discussion on the debt. Some will argue not enough discussion on the debt, but a lot of economists and policymakers have been warning that we are not taking our fiscal responsibility seriously in terms of managing debt. Of course, I think this is a topic that we need to dive in separately. What is the cost of the debt? Which are the segments that contribute the most, and how exactly are you going to bring it under control? But just from a historical perspective, the best way to think about debt is to think about debt to GDP. This is the most popular way that people think about debt. Historically, I'm talking about history, right? 1800s, back to 1900s, we were less than 10%. Debt to GDP ratio was less than 10%. Then it gradually goes up. So 1910s, it's 15%, 1930s, it's 45%. Then there's a temporary spike in the 1940s because of the World War. And we go to 118%, which is before the year 2000, that was a historical record of 118% debt to GDP ratio in the 40s. That goes down to 70% in the 50s, 45% in the 60s, 35% in the 70s. So it's gradually going down. It's going in the right direction. Then comes the 80s, it goes back up to 50%. 90s goes back up again, 65%. 2000s, it's 80%. And in the 2010s, we crossed the 100% mark. And our debt is exactly the same as our GDP. Fast forward to today, we are looking at anywhere between 100 and around 127% of the GDP to debt ratio. So this is something that is very important to think about and understand its impact, right? Because at this point, I believe the latest budget had close to $1 trillion of spending allocated to defense. Our maintenance on our debt, like our interest on our debt, is now the same as what we are going to spend on defense, which is ridiculous if you think about how much money we are going to be spending going forward just to service our debt. And this is very important also because it's important for the world markets to have confidence in the US economy and the debt and our ability to make sure that this is financed properly, because that's a backbone of why the US dollar is considered to be one of the most stable and reliable currencies in the world. This is why the monetary policies that we have and the systems we have set up and the institutions and their independence is really important because they're all interconnected. But debt is something that we are going to be soon having a very serious discussion about from a national perspective.
Yeah, it's like saying, if you make $100 a month, you owe $127 a month, right? You do this over and over, and you got to scratch your head like something has to collapse here. And this has been the subject of a lot of policymakers and their discussions. But if you hone in on the numbers, right, you would think that the way Trump spoke in his campaign, that we'd have much more fiscally conservative government. But breaking down the numbers, I'll share this with you. If you look at the federal debt from the end of the Biden administration through 2025, under President Trump's second term, national debt continued to grow every year. It did grow under Biden, but it also grew under Trump. Under Biden, from 2021 to 2024, the U.S. debt climbed steadily, crossing about 30 trillion, reaching around 33 trillion by late 2024, with federal deficits remaining structurally large post-COVID and with other spending that persisted. Now, in 2025, the debt grew, but it accelerated, hitting records of about 38.5 trillion by year end. And so our debt exploded by 5 trillion in 1 year. The fastest trillion-dollar increases measured outside the pandemic era. This continued rise in debt definitely brings up and suggests ongoing fiscal challenges, rising interest costs, even credit rating pressure. If you remember, our government's credit rating was actually downgraded last year, which is kind of scary. I don't know if the average person knows anything about that, but it did happen. Now, what caused debt to grow? Again, some of this was entitlement spending, some of this was rising interest payments, some of this was defense and discretionary outlays. We had a lot of war funding there. A big thing in the news that did contribute to our debt was the One Big Beautiful Act. The Republican controlled Congress passed the One Big Beautiful Bill Act that made large tax cuts permanent, expanded deductions like the SALT cap, boosted standard deductions, added exemptions on tips and overtime, all good things, right? If you're filing your tax returns this year, like you're going to have smiles on your face. The bad thing is this is really bad for our governmental debt. The 2017 individual and corporate tax rates were cut in place. reducing federal revenues significantly compared with what revenues would have been under prior rules. This means larger deficits, faster debt growth in 2025, even without major spending increases alongside it. And so, as Biju mentioned, our debt to GDP is about between 125 to 127%, which is not good. That's not good for any administration, whether you're Republican or Democrat. So someone's eventually going to have to deal with this problem. Whoever fixes it is going to be a genius, but this is something that is dragging on the US economy. And so something that will most likely be a big problem in the upcoming future. We want to end with this topic, and this has been on the news a lot this year. Everyone's been talking about this. President Trump issued a barrage of tariffs all over 2025 on different countries. What's been the impact from tariffs? You listen to someone on the right, and they'll say it's been great, more revenue, bring back manufacturing jobs. You talk to someone on the left, and they say quite the opposite. But what's been the real impact from tariffs on our economy? I think you're muted.
So this is a very hot conversation starting Liberation Day last year. President Trump strongly believes in tariffs for multiple reasons. It's not a one-dimensional problem that he's solving with tariffs. A lot of times he's doing it for negotiation purposes. So we have a fundamental principle that the Western civilization tries to abide by, which is called the free trade. So what we have observed is it's not the problem is the issue. The free trade is good as long as it's done fairly, and that's where we have hit a lot of road bumps, especially with economies like China, who don't play fair in the agreement. So a lot of times he's trying to counter this imbalance and this unfairness when people buy. The reason why we have to buy more than we sell them is reasons like they artificially lower the cost. Therefore, it's cheaper artificially because it's subsidized by the government. Or there are other countries that put up barriers, whether they have restrictions in their imports, like it has to meet XYZ for that product to enter our market. Or there are trade barriers, like India, for example, has tariffs. Like a lot of countries in the world have tariffs, so it's nothing new. But when economists compare it, they're normally directly going back to their point of reference from the past, which is the 1930, when the Smoot-Hawley Act was passed, and it raised the tariffs at that point to like 20% or so. And remember, this is right around the Great Depression time, right? And it triggered retaliation by our trading partners at the time, and the countries basically started cutting imports to the U.S. Pretty drastically, like 30-ish%. And then suddenly our exports started falling, and it caused a lot of issues. It's considered to be a very damaging policy of that era, of the Depression era. And it was not the sole cause of the whole downturn that happened, but it's considered to be something that amplified the issues that we saw. So the question is that a great comparison? And economists agree that they definitely agree now, because whatever they predicted did not happen. But they agree now that it's probably not a great comparison, because President Trump has definitely raised the rates, right? But his has not been flat out. It's been targeted. There is steel and aluminum tariff that's about 50% tariffs. Then there are certain countries that are getting low tariffs, certain countries that are getting high tariffs. So it's not a one size fits all. So he's using it depending on the industry to calibrate how we want our base to grow or more manufacturing to come. For example, in the auto industry, the tariff is not for foreign companies per se, right? It's for foreign companies who have to bring in the equipment. So as long as you make it in the US, it's fine. There's no tariff. So it can be a foreign company, it can be a foreign vehicle like Toyota, doesn't matter. As long as it's manufactured in the USA, there's no tariff. The tariffs have brought in a good chunk of money. It's a direct revenue impact, direct impact to the government, and it starts helping calibrate some of the trade deficit issue, which is one of the dimensions he wanted to solve. So one of the things that happened, and I don't have the exact numbers with me, the imports did fall, exports did rise, and our trade deficit was more aligned with was getting moving in the direction of where we wanted it to go. So tariffs, a lot of countries, and that's how we are also partly using it, it's used to protect industries so that it can thrive within the economy, right? Otherwise, businesses are always going to go for the cheaper ones. In a free market economy like ours, businesses always import whatever they can do cheap if it's more costly for them to make it here. So it's meant to kind of balance it out. But the risk is that you may raise the cost for the average citizen to buy the product. So that's where the balance is. But what we have seen so far is that companies, even though their costs, like we would think their costs went up, this is exactly what the government was predicting. What we've noticed is like the exporter and the importer have been able to balance out most of that cost, absorb it, and not completely pass it on to the consumer. The costs have risen a little bit, but I think it's like 0.51% or something has been the rising in costs. Nowhere near the average, I believe it's like 15, 17% average tariff that is in play right now.
Yeah, that's excellent analysis. To think, tariff is not meant to be a permanent piece of legislation, right? It's meant to protect industries in the country. It's meant to create internal supply chains. It's meant to create fair trade deals between countries where the US has frankly been ripped off by many countries. But specifically, when you look at 2025, the Trump administration, they imposed sweeping tariffs on a wide range of goods, as you mentioned, a lot of higher tariffs on Chinese imports, Canadian and Mexican goods, which did not make our neighbors happy, tariffs on automobile, steel, aluminum, and more. Some of those tariffs on automobiles were needed. The Chinese could have easily flooded the US market with $20,000 electric vehicles, would have put a lot of American industries out of business. And so some of these tariffs, though you don't like them, maybe as a listener, they were necessary. And these actions raised the average effective US tariff rate to historically high levels. And again, tariffs were intended to protect industry, create internal supply chains, raise revenue, reduce the trade deficit, revive domestic industries, force trading partners to change practices. There were some negative impacts, however, on consumers. Prices rose about 2.3% on average in the short run. Now, that's not a large increase. We talked about is about 2 to 3% a year anyway. So there's mixed reviews here on what actually has caused some of these prices to increase. Many people believe that lower income households have faced a disproportionately higher burden as tariffs took a larger share of their income. We'll see more in 2026 how this really plays out. But for a lot of people, everyday goods became more expensive. Clothing and textiles, about 15 to 17%. Food and grocery, about 3%. Motor vehicles and auto parts, about 8 to 9%. Many people reported changes in buying behavior. Many people became more frugal in 2025, particularly in categories like clothing and electronics. Maybe you decided to not buy that second pair of pants or not buy that dress because it just was a lot more expensive this year than ever before. Economists also estimate that there could have been some downward pressure on GDP, probably reduced US real GDP by about 1 percentage point. Also caused input prices for electronics and cars and manufacturing to be more expensive, hurting competitiveness. Now, though tariffs did raise money, right, there is some fact checking regarding exactly how much money that raised and whether it was enough to offset some of the major policy promises like the One Big Beautiful Act or other large deficit reductions. Some firms, like we mentioned, automakers, electronic firms, faced higher materials costs. There were mixed employment effects. Now, what's interesting is that a lot of the countries retaliated with higher tariffs on us as well. Before and during 2025, major U.S. trading partners imposed retaliatory tariffs on U.S. American exports. If you listen to the news, it was kind of like just like a battle at one point between countries deciding who can raise the highest tariff on whatever industry they needed. China hit U.S. farm goods and other products with taxes or levies as high as mid 30% range. The EU targeted poultry, juice, soybeans, motor vehicles, and multi-billion euro measures. Canada, our friend, applied 25% tariffs on autos and a wide range of consumer items. Mexico threatened and coordinated responses. Brazil responded to U.S. tariff hikes with its own reciprocal measures. India faced very high tariffs, up to 50%, sparking trade tensions, calling for U.S. Brand boycotts. Many of these were part of these broader trade disputes that weren't just limited to just 2025, but nevertheless escalated the tone and escalated the hostility around these free markets in the world. And so the effect of tariffs, I think, is yet to be seen. I think 2026 and 2027 will be much more telling in how these policies play out, as are many. But as Christians, right, as a believer, for a lot of people, you're home and you're scared because the healthcare costs are higher and you're spending a lot of money on groceries. The Bible gives us promises, right? In Philippians 4:19, right? Paul said, "My God will meet all your needs according to his riches in Christ Jesus." Now, to put a caveat on that, he doesn't say wants, he doesn't say he'll finance your next BMW, but God promises to meet our needs in scripture. And as a believer, right, we should find comfort in that. You have a God that loves you and cares about you and sees your needs, and he understands what's happening in your financial world. There are many other promises in scripture where God talks about his presence being with us wherever we go. And so, for a lot of people, you stay home, and as you lay on your bed at night and you're about to fall asleep, you're thinking about your bills. You're thinking about how much you have to pay for that next medical appointment. And so it's something that really affects all of us every single day. But the Bible offers us comfort. And so we're to turn to Jesus in these times, right? If you're sitting and you're listening and you're just really broken about money in your life, God knows, right? He sees what you don't have, and he's ready to walk you through that season of guiding you and giving you wisdom on how to manage finances well. Any concluding thoughts as we wrap up here?
Good point, right? I mean, the Bible says, God shall supply all my needs in accordance to his riches in Christ Jesus. Whatever you need, we're not talking about expensive vacation to Bermuda, but whatever you need, God will supply. And you can be confident because God says it. In terms of there was one point I forgot to mention about tariffs. It's important to note when we think about tariffs and before we get all riled up on it, President Biden kept almost all the tariffs in place. All the tariffs on China was in place, all the other goods tariffs, all of them he reviewed and kept in place. There was only, I think, some minor tariffs like the importing washing machines and stuff like that that got expired, but everything else was left in place, which tells you a little bit about what both administrations think. It's easy to listen to rhetoric and come to the wrong conclusion. The encouragement that I have for our audience is review both sides, do careful critical analysis, resist the temptation for um, emotional reactions. Like the economy, when we look at the economy, you always have to look at it as a balanced approach. But ultimately, now that you brought up the biblical aspect of it, I'll tell you that it is God who sustains a country. It is God who sustains a home. Right? There is a verse. I probably won't quote it correctly, but it says, if God doesn't watch over a city, the watchman watches in vain. So if God is not watching over the US or our economy or our needs, it is all in vain.
Excellent points. Yeah, and as a country, right, our focus and our gaze should be upon him. Thank you all for listening to another episode of The Balanced Lens. Thank you, Biju, for taking time to be with us today. We hope you enjoy our hopefully objective analysis, pragmatic opinions on how the economy is doing. Encourage you guys to like and subscribe and tune in for our next episode. Thanks, everyone.